Today on the Purpose-Based Retirement, 5 investment rules that always work, avoiding required minimum distributions on your IRAs, and why Social Security planning is so important.
Welcome to the Purpose-Based Retirement with certified financial planner practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience, helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Hey, good to see you again. I am Lee Kelso here with Casey Weade, certified financial planner. He's also the president at Howard Bailey Financial. You know, Casey and I, we talked often about the fact that we're in one of the longest bull markets in history, and it's at this point in the cycle that people start losing path. Even disciplined investors start to make mistakes.
Yeah, you know, I think times like this, we've experienced an extended period of really good times in the markets where we've had great return after great return, and you know, we're up 10%, we're up 20%. We kind of get this feeling of invincibility, and what really happens towards the end of a lot of these long cycles at the end of a bull market is something called irrational exuberance, right? So we start making mistakes by taking on more and more risk when we really don't need to in a lot of instances, and at the worst possible time, we're losing track of logic. And what I want to do is I want to bring us back and ground us in some logic. Now, hey, if you're 30 or 40 years from retirement, it's good to understand these things, but you know, the impact of a major pullback in the market probably isn't nearly as impactful as it is for someone that's 5 years out from retirement or 5 years into retirement, in that little retirement red zone where we really have to start exercising caution and understanding some of the basics of investing. So I want to bring us back to the world of logic. I want to bring us back to just a few simple rules that have been time tested by some of the best investment minds in the world time and time again.
Okay, so we're going to boil it down to 5 here for you. And first up is losing capital is destructive, but missing an opportunity is not. Now think about that one.
That's right. It's not how much money you make. It's about how much money you keep. We say that all the time, and it's very, very true. It's never more true than when you step into retirement. And if you think about what it's really like to invest in the stock market, you know, we're making educated guesses, right? I mean, let's be honest. You know, this is a world of risk. We're taking on risk when we buy a stock. The market was down 86% back in 1929 to 1932, right? In 2008, lost about half its value. We saw the same thing 2000 and 2003. It's a roller coaster. It ebbs and it flows, and we have to make sure that we understand how destructive some of those losing periods of time are. I mean, if you were going to go to Vegas, let's say you're a great poker player. I really enjoy playing poker, and I think that I'm pretty decent at it because I've got a lot of patience, and I never make big bets because I know when I'm out of chips, the game's over. I just need to slow play this thing, which irritates a lot of the people around the table. I'm not going to make big bets. I'm not going to make big swings. I'm going to make the smart bets at the right time and play conservatively, and that usually ends up making me the winner in the end. While we get other people that they win a couple games, they start getting confident, they start going all in, and they end up getting knocked out of the game. That's what can happen if you take on too much risk as you step into retirement, or if you're already a few years into retirement. If you're taking on just as much risk today as you were taking 10, 20 years ago, you can expect the same consequences, only probably worse, because now you need that for income. You can't afford to not have those chips. So let's make some small bets. Let's play the slow game and make sure that you can stay in the game for the long run.
And that time reference is important because rule number 2 is one of the most invaluable commodities is irreplaceable, and that is time.
Exactly, and it's all about time and timing. I mean, if we go back to the early 2000s, you know, if we look at what happened after the tech bubble burst, the peak of the market in 2000, it took people 14 years on an inflation-adjusted basis to get back to even. Okay? And over the last 18 years, we've seen the market average just shy of 3%, for 18 years. But what do we always hear about? We always hear about how well the market's done last year, how well it's done over the last 5 years. But the reality is that most people probably would have done better in a CD over the last 20 years than investing in the stock market. It's all about timing, and just trying to get back to even, that's not an investment strategy. And sometimes we find ourselves taking on too much risk at a time we just shouldn't be doing it. I had a couple that I implemented a plan for recently that kind of had that attitude. They were all in all the time. They were largely in international equities, which have performed fairly well over the last couple of years. They said, I like 10 to 12%. And so let's take a look at the amount of risk you're taking in order to get to that 10 to 12%. They could potentially lose half of their life savings or more. They had about $3 million and they wanted to retire in 3 years. Okay? Everything's in equities. They're all in all the time. And if they need $100,000 in annual income, they only needed 3% of that $3 million. They had enough. They won the game. They needed to say, it's okay. We don't have to do that. But he said, I want to take that risk because, I can go back to work. I can keep working if I want to. I can extend my period of time working at a job that I hate. So, well, you don't have to, so why would you? Because if that 3 million turns into 3.5 over the next 3 years, it won't change your spending habits. It won't change your life one bit. If it turns from 3 million into 1 million, it's a game changer. You're working, you've got additional stress, and it'll probably affect his health.
Wow, I hope they took your advice.
They did. They did.
I hope they
did.
Of course. So another big mistake is people confuse a cyclical trend and think it's just going to go on forever.
Right. Yeah. And I think if we go back and we think of what the market was like in 2007, right? We look at 2007, even 2006. We go, boy, the market's doing so well, right? We think that the trends, we mistake these cyclical trends, these bull and bear markets for permanent trends, right? Well, that doesn't even make it a trend then. We're looking at something that's going to extend forever. People continued to pile in the market thinking, well, this thing's never going to go down. Things are just too good. And then during 2008, the opposite happened. Everybody thought it was going to zero, right? And that's just not reality. These extremes are not reality. It's these cycles that we go through, and it's so difficult. Nobody can recognize exactly where we're at in a trend, okay? Or everybody would be going to that one person that knows exactly what the market's going to do next year. And the reality is that's not the case. But I have run into people that are pretty good at looking at just the logical parts of the market and going, it really just doesn't make sense that we could continue to pile money into a market that's this darn expensive. I don't understand the pricing, and I know historically we're in for a major pullback. We're in for another bear market because this bull market's just lasted so long. I had a gentleman that I met with the other day that has, over the last couple of years, he's taken everything out of equities and he's moved it into CDs. And he goes, I've got it in these CDs, I'm pretty happy making 2 or 3%, but I might be wrong again. He's been wrong the last couple of years as the markets continue to trend up. And so we repositioned a lot of those dollars into accounts that give him a minimum return that's about what he's getting in his CDs, but now he can make as much as 10% if the market goes up. So it goes up 20, he gets 10. It goes down 20, he says, now I want to buy. Well, then he's got liquidity and he can take those funds back out and he can dollar cost average or move them back into equities when he feels more confident that the trend has transitioned from bull to bear back to bull again.
This one you had to explain to me, but it is, if you think you've got it all figured out, sell everything.
Well, I think there's something to be said about that. Now, that is a little tongue-in-cheek.
Yeah.
However, let's imagine someone that invested in Amazon 12 months ago. If they invested in Amazon about a year ago, they would have made over 50% in the way of return, and I guarantee they feel like they're a genius, right? They're the world's best stock picker. And I've seen this happen to individuals time and time again. We had a couple we worked with a few years ago where he was doing such a great job managing his individual stocks. You could see the returns year after year that he started bragging and sharing his stock tips with everybody that he could possibly talk to. And then what happened? The energy bubble burst. One of the biggest stock market crashes in history that nobody talked about was energy coming crashing down while he was overweighted in energy. He was doing so well in energy, and then he lost over half of their life savings in a matter of months. Then the same thing could happen to Amazon. We might say, boy, I'm a really good stock picker. It's up 50%. I turned $1 million into $1.5 million. But if you don't lock in your gains, that $1.5 million could turn into $750,000. It could turn into $500,000. I think Amazon's a great company. However, we never know what's going to happen in Washington. We never know what's happening within that company until it's too late. And so we really have to make sure that we're recognizing that we may not be the most brilliant individuals in the world just because we picked a couple of good stocks. We always need to keep our heads strong and know that we need to have some degree of safety just in case we're wrong. We need to have that safety in the way of guarantees. We need to have that safety in the way of liquidity. We need to have that safety in the way of having some cash on the sidelines. We have to always be prepared no matter how smart we think we are.
And then we're going to wrap it up real quickly, about a minute left. Benchmarking performance only benefits who? Wall Street.
Benefits Wall Street. When money moves, that's when commissions and fees are made. So when you look at benchmarks and style boxes, if I tell you you made 12% last year, you're really happy until I tell you that somebody else made 14%.
Right.
All of those benchmarks don't matter. It's all about your personal situation, your hurdle rate, what is your required rate of return, and we try to hit that required rate of return every single year. It's your benchmark, nobody else's. You're an individual, and so is your portfolio, so is your retirement plan.
Well, if you don't feel as though you're getting that kind of individual guidance that you need, be one of the next 10 people to jump on the line and get a hold of Howard Bailey Financial for a complimentary review of what's going on in your portfolio, an opportunity to see how well are you lining up with these 5 rules for success we just gave you. Are you paying taxes and fees you shouldn't be? Many other factors that can affect not only how much income you're going to have in retirement, but also healthcare, other things you need to be paying attention to. And if you're not, it could come back to bite you in the long run. So I hope you're one of the next 10 people to jump on the phone, give a call, and request that complimentary review. Sit down with Casey, a member of the Howard Bailey team, and get yourself headed toward a purpose-based retirement. All right, we're going to be taking viewer questions when we come back.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
Let me help you create the retirement you dream of. Go to my website and pick one of 3 education options to get started today. Get a copy of one of my retirement planning books, sign up for a Purpose-Based Retirement live event, or go to the Purpose-Based Retirement University. 2 days of college-level retirement planning instruction. With the right education and proper coaching, I believe anyone can create the retirement they dream of. It all begins with one step. Visit thepurposebasedretirement.com.
And we're going to be visiting Ohio, Michigan, and Huntington, Indiana as our viewer questions today. So let's jump over to Huntington first. And Barb, what's your question?
How much of my pre-retirement income will I need in retirement generally?
Well, Barb, I'm glad you added that little word there, generally, right? And that's a very important word because we've often heard these rules of thumb that are 60 to 80% is typically the number that's used. It says, well, your pre-retirement income will need to be about 60 to 80% of your post-retirement income will need to be about 60-80% of your pre-retirement. So if you're creating about $100,000 in income prior to retirement, then you'll probably need about 60 to 80,000 when you ultimately retire. I think that's a great rule of thumb for somebody that's maybe 20 decades out from retirement and you're just trying to figure out how much you should be saving on a regular basis. But even then, it's not about your income, it's about your expenses. We need to make sure we're focusing on the right thing, and it's not how much income you have, it's about your expenses. And one of the important things for you to think about there is taxes. So you might have more of a tax-free income during your retirement years if you've done appropriate tax planning, so you don't need as much in the way of income in order to meet your expenses after taxes, because all of your W-2 income during your working years was taxed at ordinary income tax rates. Maybe when you retire, we're generating more long-term capital gains. Some tax at 0%, some tax at 15%. Maybe it's coming from Roth IRAs because we've done a great job of managing our traditional IRAs and doing Roth conversions or making contributions to our Roth 401k instead of our traditional 401k. So really make sure you're focusing on your expenses, not your income, and ultimately sitting down and figuring out what you want to do in retirement. Spend a day in retirement before you get there. Wake up in the morning, what do you do? What do you spend your time doing? Many of the people we work with spend more in retirement than they did while they were working. So get down to the dollars and cents. You're asking great questions. You're on the right track.
Let's jump up to Michigan. Carrie and Niles, what's your question?
What's the difference between a CD and a fixed annuity? They both seem the same to me.
Well, Carrie, they act very similarly. However, there are some very important differences between a CD and a fixed annuity. Typically, the first and most important, I think, is how they're backed. So if you have a CD, it's backed by the FDIC. If you have a fixed annuity, then it's backed by the claims paying ability of that insurance company. So first and foremost, we want to make sure we've got a very strong insurance company backing those deposits. Many more banks go under each and every year than we see insurance companies go under due to the leverage that banks are allowed to take, where insurance companies can't leverage to the extent that banks can. So one, understand the degree of safety that you have. Number two is understanding your liquidity provisions. So with the CD, if we talk about penalties, you typically have an interest penalty only, maybe 3 to 6 months interest penalty. Some of them today are going as high as 1% penalty of your principal. So understand what those penalties are inside of those accounts. When you talk about fixed annuities, typically the penalties are quite a bit higher. However, the rates that they pay are typically 2 to 3 times what you're getting at the bank. So if you have a 2% CD at the bank for 5 years, you might be able to get closer to a 4% rate with a fixed rate annuity. Liquidity within the account outside of penalties would be how much can I take out of that account each and every year. If it's a CD, usually it's interest only. Sometimes there's nothing you can take out. Usually with fixed annuities, you can take as much as 10% of your account value each and every year. Now, fixed annuities can make a good CD alternative if it's longer term funds. And we don't need that as maybe an extended emergency fund, which a lot of people think of their CDs as extended emergency funds. They go, well, I'm going to leave this much in my savings, I'm going to put this much in a CD, and maybe you want to put a little overflow in a fixed annuity, but make sure you utilize all those different tools for the job that they were meant for. Find the closest distance between 2 points. It's a straight line. That's what my cross-country coach always told me, and applies to finances as well.
We're in a straight line over to Van Wert, Ohio, and Linda, go right ahead.
What strategies can be used to avoid required minimum distributions on my retirement account?
Well, Linda, this is a question that it seems like everybody has. Everybody wants to figure out, how can I eliminate my required minimum distributions when we don't need the income? Because a lot of retirees, they save for years in these 401ks and IRAs, and then they end up with this decent pension, decent Social Security, and they go through their go-go years, and then they hit their slow-go years in their 70s, 75, 80, and they end up getting into their no-go years, and they spend less and less of that IRA, but they're forced to begin taking distributions at one of the times when they really don't need to take those distributions, and those are your required minimum distributions. After the age of 70 and a half, you're forced to start taking those distributions, whether you want them or not. And there's really no way to just purely avoid those distributions. You have to take them. However, there is one thing that you might think about if you're charitably inclined. A lot of the families we work with tithe on a regular basis, and instead of taking that required distribution, paying taxes on it, and then giving it to a charity, which is a problem. Giving the expansion of the standard deduction, you can't itemize anymore, most likely, unless you have a massive amount of itemized deductions, and so you're not getting a benefit out of that tithe that you're doing every single year. But if you take that RMD and send it directly to the charity, or directly to your church for that matter, then you can avoid those taxes and get the full tax benefit out of that distribution in the first place. So a QCD is a good place to start, and ultimately we want to figure out, if you're going to keep hold of those funds, how we're going to more importantly reinvest them so you don't continue to pay taxes on them the rest of your life.
Thanks for all those great questions. And if you have questions, a good place to start is to be one of the next 10 people to jump on the phone and request a complimentary review of what's happening in your financial life. How well structured are you right now for retirement? Are there income plans in place? What about long-term care? The tax advantages that Casey just talked about, are you capturing all that you can? Good things to think about, and sit down with a Howard Bailey representative. So be one of the next 10 people to jump on the phone, request that complimentary review, and you'll get yourself headed down the road toward a a purpose-based retirement. Okay, our question of the day has to do with Social Security. And how many times does a financial advisor discuss Social Security with their clients? What percentage of the advisors out there are doing that? We'll have the answer when we come back.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out.
So going into the break, we asked you an important question. It had to do with how many financial advisors are actually discussing Social Security with their clients. Casey, what's the answer?
According to surveys conducted by thinkadvisor.com, that number is only 13%. 13% of advisors are having that Social Security discussion with the individuals that they're working with the individuals that they're supposed to be managing their life savings and their retirement strategy. And what I think is even more astounding is only 40% of those conversations regarding Social Security planning were actually started and initiated by financial advisors themselves. That means the majority of these Social Security decisions and discussions are being brought up by people just like yourselves to their financial advisors. Why is that? Because we're talking about a very important decision, and it may not seem like a big decision. Let's say, for instance, you have a $20,000 annual Social Security benefit. You say, well, it's only $20,000. However, $20,000 that's an inflation-adjusted income would take about $500,000 in a lump sum in order to recreate on an inflation-adjusted basis. So that $20,000 decision is really a $500,000 decision. And we want to make sure that we make the very best decision for yourself and your family moving forward. What we're going to do here is we're going to share with you what it looks like when the team at Howard Bailey analyzes your Social Security benefits as part of an overall strategy, so you can get an idea of what that experience is like when you come in and visit with our team. We've got a couple here who are 52 and 56. They're a few years out from retirement. They're going to have a graduated retirement or a bridge to retirement where they're going to be working a little bit less each and every year as they get closer and closer to that Social Security age. Their full retirement age benefit is about $2,200 and $1,700. That full retirement age benefit for them is age 67. As it is for most people, it's 67 years old is when you get your full retirement age benefit. But that is a bit of a misnomer because you actually get your maximum benefit at age 70. So I had a gentleman that just the other day said, I can't retire to my full retirement. Well, the reality was he could actually get more benefits till he waited till age 70, and he could get by with his benefits starting at age 65 coupled up with Medicare. So we want to make sure we really understand what that benefit really means at full retirement age. It is the number of which we can derive all the other benefits you'll receive at various other ages. They assumed they would have a very long lifetime. They had both had parents that lived well into their 90s, so we assumed 90 and 92 years old. We always assumed that the spouse lives just a little bit longer due to being female and having the average lifespan just a little bit longer than what we see a male have. We are not figuring in a reinvestment rate because they're going to need this income in order to live off of, but this is an important factor that you want to factor in. If you don't need that Social Security income and you're going to reinvest it, that can help you decide if you should take it while you're still working part-time, even if you don't need the income. The cost of living adjustment on Social Security, we're figuring at 2%. Which over the last decade, it's been just under 2%. Long term, it's been around 4%. And we are taking a look at a married couple. That's a very important decision because as a married couple, this makes this decision just a little bit more complex and there's a little bit more planning that's ultimately going to be involved. If we waited until age 70 for both spouses, they're going to receive the maximum amount out of Social Security at around $2 million over their lifetime. If we take a look at filing early at age 62, they're going to get get about $500,000 less at $1.5 million. If we delay the male's benefit to age 67, but take the smaller benefit, the female's benefit at age 62, now we've maximized benefits for the survivor, which will most likely be her, and we've delayed the largest of the two benefits. We end up with about $1.7 million in benefits. So let's start looking at the dollars and cents. At age 70, if we were to file for our maximum benefits at age 70, of which we'd collect $2 million in benefits, by the time we get to 70, we would have collected just over $218,000 or $220,000 by the time we were 70. If we filed at age 62, by the time we get to age 70, we actually collect $455,000. So in order for us to delay from age 62 to age 70, it's going to cost about $235,000 out of their investment portfolio to meet that gap. Let's take a look at it another way. Let's say that we delay the larger of the two benefits till age 67 and take the spouse's benefit at age 62. Over that period of time, we still collect $220,000 if we file both benefits at age 70. $380,000 is the amount we would collect by the time we got to 70 if we file at 67 and 62. So now it's only costing us about $160,000 to delay. And ultimately, that's the decision we made. These are all the different ways that we could have filed for their Social Security benefits. And ultimately, this is the strategy that we've went along with. We've started his benefits at age 67. Her benefits will start at age 62. And what this is allowing us to do is, one, it's allowing us to reduce our Social Security taxes during that Roth conversion period. So as they slowly step closer and closer to retirement, over the next few years, we're going to be converting more and more of their traditional IRAs to Roth IRAs and maintaining a 12% tax bracket that we know will be 15% at some point in the future. By the time they have both Social Security benefits on, they're going to have almost all of their traditional IRA over to Roth IRA and tax-free, which will minimize their Social Security taxes long run as well. It's also allowed for an increased amount of the survivor's benefits, knowing that she's most likely going to live longer. They're delaying a benefit that's increasing at 8% every year. Because of that delay, that's going to allow more income to the survivor once one of the two of them passes away. And we've also minimized their asset drawdown by finding a nice middle point that doesn't cost them as much to get as much in benefit as they possibly can.
You know, the takeaway for me there, Casey, I mean, you threw around a lot of numbers, but my main takeaway is that is an incredibly complex decision, and I don't think most people should be making it on their own.
Right. I think it's one that needs consultation and just discussion, if nothing else. Maybe you're already dead set on taking it at 62 or 70, but why not sit down and have a discussion and realize that it's a piece of the puzzle when it comes to your financial plan. It doesn't live in a vacuum. We have to take into consideration taxes, estate planning, income planning. Everything has to be taken into consideration before you make that decision.
And I hope, like me, you're going to be smart enough to reach out for some professional assistance. And the first step in doing that is to pick up the phone and be one of the next 10 people to call right now and request a complimentary review of your financial scenario. How are you structured? Is Social Security optimized in your career, in your work, in your retirement future, rather? Are there other things you could be doing today to make sure that the smart steps are going to pay off for the rest of your retirement? All important questions that you'll discuss in a complimentary review. So jump on the phone and be one of the next 10 people to call and sit down with Casey or a member of the team and get yourself headed in the right direction on Social Security and so many other factors. And if you're not quite ready to take that step, visit the Purpose-Based Retirement. You can request a copy of one of Casey's books or find out how you can attend an upcoming event and learn more about the Purpose-Based Retirement. We'll see you next week.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.